Today, we got a question from Tim, who is making an offer on a business, and the seller needs to stick around for a full year, but obviously wants to be paid for that work. How do you fund transitional salaries for sellers when you buy a business? I mean, like, where does the money come from? We're going to dive into it today.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
Hey, everyone. I've got a great email message question from Tim. I'm going to share it here on the screen. I'm going to go through the question. We're going to discuss it. We're going to break it apart. I'm going to give you a mental framework of how to better understand the scenario, which has its parallels in other aspects of small business buying that we discuss quite often. And then I'm going to show you what the possible solutions are, and then give you a story of what actually was the end solution amongst a buyer and seller that I was working with. So I can show you how a real workable example can be sorted out that can help both parties get what they need, and most importantly, help other parties like a bank, for example, be happy with the resolution. So first of all, let me pop this up on the screen for everyone to see. So it says it's from Tim, and this is from January of 2025. Hi, Dave. Hope you're doing well. I'm a BBA student, and we previously corresponded. So thank you very much for enrolling in the program, Tim. Hey, I noticed the other day there's over 100 5-star ratings, and there's a bunch of reviews starting to populate in there. If you've also done Business Buyer Advantage, please leave a review. It really helps anyone who wants to check out the program. So he says, my company is moving into the LOI phase to acquire a small business. It does roughly $500,000 a year in EBITDA plus a $250,000 owner salary. So then recall, everyone, if we add those two numbers together, we get the seller's discretionary earnings. So this is a pretty good sized company. We are planning to do a 12-month transition period where both the owner and I will be full time. Okay. He will then be retained on as a needed consulting basis. So, what Tim is about to get into here is that this business operates today with this profit, this $500,000 of EBITDA, while the owner's taking a salary. And so, during the period of this 1 year, the issue is, now we're going to have two people, two top dogs taking a big salary. He says, I'm struggling to get an answer on how we fund the owner's 12-month salary, as I will also need to take the salary during that period. So when Tim says the salary, I'm going to surmise that it means that Tim additionally needs a $250,000 salary. He's planning on taking that out. So he says, do we take the EBITDA hit for the first year? So do we just spend the money and have reduced profitability? Well, you could. There's a problem with that. We're going to get into that. Does he take a loan from the bank? Should he include it in the seller financing portion or split the salary 50-50 for the first year? He said, although I'm sure this will be unattractive to the seller. Appreciate your insights as always. And yeah, I appreciate the question. So let's dive into it. Let's talk about this. I've got a few notes over here on the side. So first of all, normally when a business is sold, just part of the deal, like you put a value on a business, you pay the price. Part of the deal is some sort of training and transition period where the seller sticks around and helps you take over the business. Now, typically, this is a much shorter period of time than a year, right? So, in a small retail business, someone might stick around for a few weeks and then make themselves available on the phone after that. I often encourage people in, a lot of businesses to think both short and long term as far as transition. So I've said to a lot of people over the years, when you're taking over business, maybe get the seller to stick around for a couple of weeks. and then have the right maybe to recall them for 5 or 6 full days at some point during the next year, right? So you get some experience in the business after a couple of months, and then these infrequent things that have to be dealt with start to pop up, and then you can say to the seller, come on in and spend an afternoon with me or a day. I'd like to go over these things that are kind of more infrequent that have come up since you were last here. I find that works really well for a lot of small businesses. When we get into things like a 1 year transition, what we're typically getting into then is a more complex kind of business environment. Or maybe there's some kind of key element of business goodwill, or maybe the goodwill, in fact, was resident within the seller. And so now we're starting to discuss, hey, we need this person to stick around because their presence is going to create confidence in the customers. And there's so much that we need to learn from this seller that maybe isn't clearly documented or recorded in one way or another, that we just need access to this person all the time. And then people start to get into these longer transitions. In an extreme example, if you have a business that is entirely sort of headed up by one person, and all of the market sort of is attached to that one person. Like if I tried to sell my business, right? Anybody who buys my business is going to be like, yeah, Dave, we need you to stick around and make YouTube videos for another few years. And what would that look like? Like, um, the new owner maybe would be like the co-host of the show, right? And so that everybody in the audience would get to know that person too. And then eventually I fade away and the other person's in there. But it's not something that's going to happen over 3 weeks, likely, right? And so we think about, firms with leaders who are maybe award-winning professionals in their own discipline, like the architect who's won awards is the famous example I like to use. So this is the kind of scenario that we're dealing with here. For some reason, the buyer and seller have come to the idea that the seller needs to stick around for a full year. And the seller, who's been paying themselves $250,000 a year, obviously is going to want to work for the same salary, right? Because they're punching the clock 9 to 5, Monday to Friday. And the buyer, I'm guessing, is going to be leaving some kind of maybe a job or something, and needs a salary too. That's part of why they're buying a business, right? And so we've got a cash flow crisis in the making if we don't figure out a solution for this. So, first of all, what I want to reiterate that I've mentioned on many, many, many videos that I've done is that the price being paid to the seller is not the entire investment that a buyer is making. The seller sees the price they're receiving. That's what they see. The buyer, however, should be considering what I refer to as the project cost. Because in a lot of transactions, there are certain things that are not obtained from the seller. So, in a simple example, you might have a small business that's fairly simple, but there might be some degree of receivables and payables and some sort of operating capital. But the buyer and seller agree to do it as an asset sale, and they say we're just going to ignore that operating capital. The seller will keep the receivables and pay off their payables, and the buyer will bring a little bit of extra money for operating capital. So in that scenario, the buyer is paying money to the seller to acquire the business, but then also contributing some money to their own new entity, increasing their overall investment. And what I always say to buyers is you have to actually look at the cash flow you are obtaining, not with respect to the purchase price being paid to the seller, but with respect to your investment, right? So you are investing cash to obtain a cash flow. So if we say, for example, this 500,000 EBITDA business is being sold for 3 times EBITDA, I'm just using ballpark numbers here. I don't even know what kind of business this is. So that would be a $1.5 million price for the business, given that kind of rule of thumb metric. However, if we do in fact need the seller for a full year and we have to pay the seller $250,000, then what that means is that the buyer is actually got a total project of 1.75 million to acquire the same cash flow ultimately. Okay. Just because the money is going to be paid out as a salary from the business to the seller over the course of that first year does not mean it's any different than any other kind of additional investment that a buyer is going to make when acquiring a business. So let me draw the parallel here with other scenarios. Very frequently, if someone is buying, let's say, a franchise restaurant that someone has owned for 10 years, I was actually just involved in one of these probably 3 weeks ago. So the seller wants to sell the restaurant, the buyer wants to buy it. It's a franchise deal. And so then the buyer, analyzes the numbers of the restaurant and says, yeah, this is what I'm willing to pay. Then they make application with the franchisor to be approved as a franchisee. The franchisor then comes on the scene and says, hey, if this business is being transferred from one party to another, we won't allow the transfer until all of these different updates are done and you meet the new decor package rules and blah, 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 blah. So that franchisor basically puts the onus on the seller. They say, you cannot transfer this business over to this new person until you've made these investments. And in that scenario, it's very, very clear, right? Because the buyer's paying the seller a certain price for a cash flow, and they've determined that price based on operations. But the franchisor is not allowing the deal to happen until the seller invests. In this case, it was a couple hundred grand in like renovating the dining room, putting new signage outside, all that kind of stuff. Very easy for the buyer to understand. This is a cash flow. This is what I'm paying. All of those other costs have been put onto the seller because of the franchisor's involvement. They kind of mediate this thing, right? And so the seller doesn't have a choice. They're like locked into this thing saying, okay, well, if I want to get this deal through to get the money the buyer has offered me, then I've got to pay this money and do these renovations. When we have no franchisor, when there's no intermediary there kind of making these rules, things tend to become more muddied. I'll give you another example that's more common with a non-franchise business. Let's say you have a business that has a couple of key pieces of very expensive capital equipment, some big machines of some kind. The seller, knowing that they were going to sell the business, has deferred replacement and deferred maintenance on this equipment because they wanted to try to pull as much money out of the business as they could. And then you, as a buyer, show up, you see the cash flow, and you say, this business's cash flow is worth a certain amount to me. But then as you get into due diligence, you realize, oh my goodness, I'm going to have to replace a $400,000 machine within the first 2 years of buying this business. So what then do you want to do? You realize you don't want to pay the seller and then pay another 400,000, right? So it's very clear to you that while the business's cash flow is worth a certain amount of money, because of this imminent large investment that you're going to have to make, you think, I can't pay the seller that full amount. I have to mitigate this cost of this huge impending reinvestment that I have to do, created by the fact that the seller has not been reinvesting in the business and spending money on capex. So the business is worth less. We see this all the time where people will, reduce the price after having everything inspected and say, I'm going to pay less because of these things I'm going to have to pay. Now, in this scenario that Tim is suggesting, I will argue it is exactly the same scenario, except instead of a piece of machinery or restaurant dining room renovations, what we're talking about is an HR skills soft cost gap where Tim is deficient in some way. He doesn't have all of the skills, abilities, etc., or the business is deficient in some way, given that processes, procedures, client relationships, etc., are not documented or have never been established in a certain way that allows for easy transfer. So either way you look at it, you either say it's a problem with the business or it's a problem with the buyer. The solution to this problem is the seller sticking around for a year. Okay. So what is that? It's exactly the same as any other additional investment that has to be made on the part of the buyer. But in this case, we're talking about a salary to the seller. So, how do we reconcile this? Well, what that means is if you want to look at the analogy I just drew with the piece of machinery that needs to be replaced, it means that if in fact this problem exists, then the buyer has to ask themselves, what is the total investment I'm willing to make to acquire this cash flow? And then the price paid to the seller has to be, based upon that. So because of this deficiency that I've said, the business is actually worth less because more money has to be spent to try to fix this so that the buyer gets the cash flow that they are investing to get, right? So either the seller has to agree to provide the entire year of training and transition as part of the deal to sell the business, or the business isn't worth as much. No seller is going to be happy to hear that. No surprise to anyone who's watching this video, right? So, what are the different ways? Because Tim asked me, where do we get the money? So, when you buy a business, there are only three places you get money. One, two, three. So it's either the actual equity down payment money from the buyer, in this case from Tim, or investors if there are any. I don't know. So it's either the equity, or maybe it's from the bank if there's a bank loan, or you're going to be getting money from the seller in the form of seller financing. It's one of those three places. That's where all the money comes from. So if the money for this training and transition period is going to come from the equity and the bank loan, here's how you would do it, right? You would have to say, Mr. Seller, this is what the business is worth to me. This is what the cash flow is worth. Let's say 1.5 million. And I need you to stick around for a year in order to conduct this training and transition period. So here's what we're going to do. We're going to hold back, to use round numbers, we're going to hold back $240,000 on closing day. And every month that you work with me full time, we're going to release another 20 grand to you. Okay. And that ties the seller in to have to be present and be training you. And in this case, the valuation is based upon the value of the cash flow, but it's the deal was done on day one. The lawyer maybe is just holding the money and dripping it out every month. You could say then at the end of the 12 months, he gets all the money, or just when you declare the transition is complete, when the buyer says, you know what, I'm fully in charge here, I'm comfortable, I think I've got a handle on everything, let's release the rest of the money, right? So that's one way to do it. A lot of sellers are going to be upset about that though, because they're going to think, okay, now I'm selling my business, which is worth a certain amount. And then I also have to do all this work. But if the work is required to get the buyer what they bought, that's just part of delivery, right? And so if you think about any business selling any other kind of thing, any other piece of machinery, if you buy a big piece of machinery like for a pulp mill or something, when you buy it, it's part of the package is always a bunch of people show up to set up the machine and test the machine and integrate the machine and make sure it's running properly. I know somebody who bought a big piece of capital equipment from Turkey, and it was, imported in like 6 containers, and a bunch of guys from Turkey came over and they assembled the whole thing, and then they tested the whole thing, and the guys were here for a month, right? Doing all this work. All of that was included in the purchase price of the machine because what does a buyer want? They want the machine here in place, working, producing, creating money for myself, creating profit, doing work. So is that the only way to do it? No. And I'm going to share with you some ways, some have your cake and eat it ways that this can be done. So the other way to do it, and remember the problem is that if there's a big bank loan on this deal, that a huge chunk of the EBITDA has already been committed to debt service. So it's just the profit's not available to pay this extra salary, right? So what is the other solution? Well, if a large portion of this business transaction was being seller financed, like if 50% of the deal was being seller financed, for example, then you could say to the seller, we can pay you a salary, but you're going to have to put your seller financing on no interest, no payments for 12 months so that we have that money that would normally be going to that debt service available to pay you a salary. So we're talking about deferral. So in this scenario, if you can save enough cash flow because there's a significant seller financing note to afford that second salary, this is an example of have your cake and eat it too, where the seller could sell the business for a certain price and then create the cash flow flexibility in order to allow a salary to be paid. Um, there is another kind of solution, and I'm going to give you a real life scenario here. So this is a recent client, and I was working with the seller, and the seller was tight with the buyer. They knew each other, and the seller was part of some of the conversations with the banker too. So everybody really was talking a lot in these deals. What the buyer had to show the bank was that the seller's salary was going to be available to the business in order to help do debt service, right? So the common SDE sort of cash flow calculation. Then the buyer said, I want the seller to stick around. So then they changed the deal so that the seller would stick around similarly for a 1 year transition. However, the bank wouldn't agree to it. because the bank said, "Hey, you cannot pay the seller their salary for a year because we've used that cash flow already to demonstrate why this is a safe loan for the bank to make because the cash flow is available to provide debt service coverage ratio on this loan payment." So the bank basically refused it. They said, "If you keep this guy on and pay him a salary, we won't fund the deal." So it didn't happen, right? What ultimately was the solution? Ultimately, what was agreed to was this. There was a transition period of 3 months, which was included in the deal. So the seller sticks around for 3 months, no pay, okay? Beyond that, there is consulting at an hourly rate. So the buyer is only gonna use the seller at the hourly rate if it's deemed required, if the buyer really needs that person to stick around. But here's the catch. All of those monies paid all of the billing for the consulting work is entirely on standby until after the bank is paid in full. So the seller is gonna come around and do consulting work, and it's at X amount per hour, but whatever work is done during that first year, basically the seller has to wait 7 years in order to be able to ask the buyer to then pay those invoices. So it becomes an investment that then has to wait at the end. And that was the only solution that the bank was satisfied with because they did not want to see an additional cash flow demand on this business. And it would be another example of get your cake and eat it too, because the seller is getting the price they negotiated for the business, and they're going to get paid for this consulting, but they've got to wait. And this, basically, there's only so much cash flow to go around. There's a common expression that the business someone sells is not the business that somebody receives when they buy, because sellers see all this cash flow. In this case that Tim has sent in, the seller sees a $500,000 profit and they see their $250,000 salary, and they think to themselves, "This is a fantastic cash flowing business." But from Tim's point of view, he's going to get in there, and if he's got big bank loans, he's got huge debts that are going to have to be paid, big payments have to go out, and that really generous, profitable cash flow that the seller sees very quickly gets whittled away to very little and becomes very tight. And, it's going to be very different for Tim to manage. He's got to make sure that, no big mistakes happen, that there's no big problems, that there's no big hiccups in cash flow because of the debt service. And then if you add on top of that someone's salary, it would be stifling. There has to be some way to create more room. And if Tim were to agree to pay the regular price and then, he said in his email, "Do I borrow the money?" Borrow another $250,000 to pay the seller. Well, then what he's actually done is he's actually paid 1.75 million for the cash flow, which, might not make sense, right? It might be too much. Anyway, thank you very much, Tim, for sending in the question. If you've gone through this experience or had trouble in a deal where you've had this kind of thing come up, I'd love to hear about it. Put a message down below here in YouTube in the comments, and share your stories with other people. The one thing that I will reiterate is that as a buyer, you have to look at the entire investment. You have to look at what goes into paying the seller as well as everything else you're going to have to put in the deal, and you have to measure whether the deal makes sense or not for you based on the total project investment, not the purchase price. And in a lot of cases, those two numbers are very different. And if you have heard this video and then you realize, hey, um, there's a lot more to this stuff than what I've been led to believe or what I thought, then maybe you should take Tim's example and sign yourself up for Business Buyer Advantage. Business Buyer Advantage is available, of course, over at businessbuyeradvantage.com. And it's where I've got my online training, my group coaching. We also have consulting services we talk about there. Our buyer insight analysis is one of the services that we do a lot for people that want to buy a business. It's a pre-diligence examination, pre-LOI diligence examination that actually helps come up with offer prices, and usually in some cases, 3 different offers. Anyway, head over to businessbuyeradvantage.com to learn more about that. And with that, I'll say thank you very much, and we'll see you next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.